Hello and welcome, everybody. My name is Sarah Snell Cooke. I am your host and co-founder of the Credit Union Connection. I have with me today Mariam Janan. Welcome.
Thank you. Glad to be here.
And Mariam is the CEO and founder of CEO Acceptance Group. It started it when you were a teenager, right?
I was 19 when I started.
Yeah. So why don't you give us a little of your background and a little bit about the company?
Okay. So I've been doing this for a little over 25 years, about 27 years. I was working in banks and credit unions. I did an internship at a bank, learned a lot about banking, learned a lot about credit unions. Simultaneously, I was buying and selling cars. Specifically, I was going to insurance auto auctions, buying cars and remarketing them. And um, in that field, I learned, I met a lot of dealers. I met a lot of auto dealers. I learned about that side of the industry. I got to know that credit unions needed auto loans. And my family, I grew up in a culture where it was taboo to work in any men's industry. So I decided to choose the most male dominated industry to get into. So I've been doing this for, like I said, 25 plus years, and I absolutely love it. And I'm glad to be here to talk about it.
Yeah, that's awesome. We're glad to have you too. And so as you're looking ahead to 2025 for your business, give us the top three trends that you're expecting to see happen with indirect lending coming up in 2025.
So I think right now, and I think also in 2025, we're going to be seeing a lot of we're going to see a reduction in auto loans, I think, in terms of credit unions. We will. I'm seeing a lot of headlines where captives are dominating the industry, and I think that now that we're back to pre-pandemic levels in terms of new vehicles, so I think we're going to see a lot of incentivized rates, subvented rates from the captives, 0 to 4.99 rates that we can't compete with. And so I think we are going to see a lot of volume going to captives versus credit unions. And so I think that's something that we need to navigate and learn to deal with in the coming years and prepare for it. Another thing I think we're going to see is I think the used car values are going to continue to be steady. I don't think that there's going to be a decline in used car values, mainly because the average car price has increased to 45,000. So if a lot of people can't afford that, and so they're looking where before they would be looking to new cars with the higher interest rates now and the higher average cost of a new vehicle, I think consumers are going to continue to look for used cars just to get the lower pricing. I also think that liquidity issues at the credit unions are starting to get better. And I think that more credit unions are going to be looking for auto loan volume. And so hopefully that will help them to be less conservative so that they can be a competitor in that market as well. So I think those are the top three things for 2025 to keep in mind.
Mm-hmm. And so indirect lending's gotten a bad rap lately, particularly because of fraud or higher delinquencies, and indirect borrowers aren't real members. So how can we do better in this area of indirect lending?
I think that indirect lending has had a bad rap for over 20 years. And I think that started because some credit unions got into the industry without the expertise. And I think there were a few bad companies out there also preying on the credit unions and, having them do auto loans when they had no business doing them. So I think that any industry, anyone can get a bad rap. I mean, there's credit unions that, I see articles every day that somebody was arrested for fraud or went to, jail for fraud. I think that you have bad apples in every industry. And I think that that bad rap just kind of stuck around and the industries, it is kind of a small world, right? Everybody talks. I think if you have the expertise in the industry and you've got the proper practices and procedures in place, you can really protect yourself. Like one of the things that we do in our business is we interview every customer or every new member or potential new member before sending a loan off for funding to our credit unions. I think there's so many different red flag techniques that we can implement that can eliminate a lot of fraud and errors in the industry or in the business.
Mm-hmm. Yeah, and that's great because some of it's just here's a marketplace of loans and fight it out for yourself.
Correct. And what happens is some of these companies, what they do is they connect credit unions to the dealerships without the middle portion of it, which that middle portion is, building the relationships with the dealers. It's creating dealer profiles to understand, who the bad apples are and the bad players are and the bad actors are. Understanding the type of loans that are coming from each one of these dealers. There's just so many middle pieces that need to be addressed where just connecting a credit union without the expertise to a dealership just doesn't make sense.
Mm-hmm, for sure. And then one of the things we're hearing a lot about also is automation. Huge buzzword right now. And credit unions want to be more efficient, and particularly around lending, and that's great. It's a great thing to strive for. However, there can be drawbacks. And so, how does that relate to auto lending and indirect auto lending specifically?
So I think automation is fantastic. I think it's great. I think it reduces the time that we spend in looking at every loan. It also gives us the ability to automatically decline loans that we're not even a player in. But also it could be not so great. I mean, what we could also do is create a hybrid model where we use the automation part to make us a little bit more efficient. And the no-brainer loans, it automatically approves. But in terms of return on investment, we're going to be missing out if we create a cookie cutter approach. We're going to be missing out on a lot of profitable loans and potential new members that we could offer so many different services to. If we just touched the loan and looked at it and felt it and understood who the person is that we were dealing with. So again, I'm a fan of automation in order to speed things up, but the way you want to stand out with your dealers is you want to have something a little bit different, which is touching loans and looking at them and working with the dealers. Otherwise, they do have access to hundreds of lenders that are automated. And so what is it different that we bring to the table?
Yeah. And that interview piece in particular, I think, ensuring there's a human there involved and looking beyond the credit score, especially for credit unions. I mean, that is you should be doing character-based lending in addition to all kinds of other factors that you bring into play. But yeah, I mean, that's the high touch that credit unions are known for. And I think one of the better things credit unions are known for too. So, and you create again creating that distinction or that distinguishing themselves, not only with the dealers as you were mentioning, but also with the Daves of the world, but that are automating a lot of the stuff that credit union or potential credit union members are doing. Um, and there are a lot of, but back to the dealers, there are a lot of nuances to dealing with dealerships. You know, are you going to pay a flat fee or a percent, and what works, and what are you willing to take on as far as risk, and who's liable for what when if a vehicle like disappears when the first payment is missed. So, what are your top tips for credit unions for trying to um, handle the dealer relationships on their own?
So I think the most important part of the dealer relationships is having a sound dealer agreement in place. That's number one. I think that understanding what is in your dealer agreement and having a sound dealer agreement in place, it could be a first payment default clause, a fraud clause, a bankruptcy clause. So we have all those in our dealer agreements. So number one is knowing that because that obviously gives you the recourse to go after them if something happens. Number two is again, like maintaining the dealer relationships, establishing a relationship with them. If the dealer values your relationship, they will go out of their way to help you. If you have a first payment default clause, you can have a contract in place. Some dealers won't honor it, and then attorneys get involved and so on. But if you've established a relationship with them and they value your relationship, typically they'll say, no problem, bring it back, we'll buy it back. In terms of fraud and other things, it does happen. But all you can do is have the proper procedures and practices in place to protect yourself. And that again is doing customer interviews. It's creating a consistent process also with your staff so that they catch any red flags. An example would be a dealership that sends, mainly subprime loans to you. All of a sudden, they're sending a prime loan to you. You want to go, wait a minute, why is that off? And so there's different practices that again you can implement and educate your staff so that when something comes across that's like that, that triggers a red flag and requires a little more investigation.
Mm-hmm. Yep. Any kind of anomaly should be setting off those red flags. So, what are the essential ingredients to maintaining or earning that best ROI for your credit union members as it pertains to indirect lending?
I think number one would be relationships with your dealerships. That's number one, because if you have a good relationship with the dealer, you can get a diversified portfolio, which would be number two, right? So in order to get a diversified portfolio, you need to have the relationship with the dealer to allow them to cherry pick is that they allow you to cherry pick your loans from them. And so
Hmm.
you can reach out to a dealer and say, hey, I want 15 loans from you this month or 20 loans from you this month. And can you mix it up with, seven prime and seven middle prime and seven subprime? So I think diversifying the portfolio, maintaining a close relationship with your dealers, that also helps, again, mitigate risk. Uh,
Hmm.
and having having a hybrid decisioning model. And so if you become cookie cutter, then they're just going to allocate a certain amount of loans. And if you're only doing prime loans at 6% and one of those go bad, it wipes out the profit on all the rest of the loans. So, having a hybrid decisioning model allows you to take an extra step to look at it from an underwriting perspective, look at the different options that you have available. One of the things that we encourage our credit unions to do is once they decision a loan, let's say they approve a loan, they notify us and they let us know because we get on the phone with customers that they're also approved maybe for a credit card. And so we offer that at the point of interview. That way now they have two products with the credit
Hmm.
union, and then it's easier to sell a third or fourth product and establish a relationship with that member. And as we
Yeah.
all know, once you establish a relationship with the member, you could sell, sky's the limit what you can sell to.
Hmm. Right. Right. And it's all about helping them out too. So if they're in need of a credit, say consolidate debt or lower their credit card payments or interest rate, whatever.
Home equity loans or anything else,
Yeah.
absolutely.
Yeah, it's a great opportunity to build that relationship because that's one of the things you always hear about indirect lending is, oh, they never become, multi-user members but it's possible when you
It
do
is
it.
possible if we
Yeah,
work them the right way, correct.
yeah. And so we've covered a lot of things just now. All indirect lending all the time. No, but we've covered a lot of things right now. And Miriam, I want to ask you, I always allow my guests the final thoughts. So what are the last words you want to share with our audience for today?
I think that indirect lending has had a bad rap. I think if you've got the experts in place, I think if you've got the right team in place, indirect lending can be very successful for credit unions. I think in 2025, there are a lot of question marks on what's going to happen. But if you put all your best practices in place, and if you have a bad program, I mean, break it down to nothing and rebuild it properly,
Hmm.
put all the right practices and procedures in place, hire the right experts, and you could have a successful program for, 2025 and on.
Awesome. So thank you so much for your time, Miriam. I appreciate it.
Thank you. I was glad to be here. Thank you for listening to me and allowing me to share my thoughts.